Hey, welcome to our explainer. Today, we are diving deep into the investment case for Colliers International. You'll see it under the ticker CIG. Now, this is a real estate giant that's making some really big bets, and we're going to break down exactly what that could mean for you as an investor. So let's get right into it.
So, here it is, the central question we're trying to answer. You've got Colliers, a company that has completely remade itself. But, and it's a big but, they've done it right in the middle of a massive storm in the commercial real estate market, or CRE, as you'll hear it called. The real question is, can this new version of Colliers actually survive this thing?
And this is the transformation we're talking about. You used to think of Colliers as just a company that helps you buy or lease an office building. Not anymore. Think of it now like a three-legged stool. You've still got the traditional real estate services, sure, but now you've also got this fast-growing engineering arm and a really powerful investment management business. Honestly, if you can wrap your head around this shift, you'll understand the whole story.
All right, so let's start with the good stuff, the bull case. This is the optimistic take on CIG, and it's all built around one big idea: resilient diversification.
This chart gets right to the heart of it. See, old-school real estate brokers were completely at the mercy of the market. If deals weren't happening, well, their revenue just dried up. Colliers has totally flipped that script. Now, more than 70% of their earnings are recurring. That means they come from stuff like long-term property management contracts, ongoing engineering projects, and investment fees. It's like a giant, stable cushion that protects them when the market gets volatile.
And this just shows you that strategy in real time. Take a look at these numbers. The classic leasing business, it was down 5%. No big surprise there, the market is tough. But look at the other parts of the business. Outsourcing services are up a nice steady 6%. And the engineering business? It's on fire, up 67%. The new parts of the company are more than making up for the weakness in the old part. This is exactly what diversification is supposed to look like.
A big part of the bull case is just trusting the people in charge. And why would you trust them? Well, how about this for a track record? For the last 30 years, they've delivered roughly 20% compound annual returns to shareholders. That's incredible. That kind of long-term success isn't just a fluke. It tells you you're looking at a leadership team that really knows what it's doing.
Okay, but it's not all sunshine and roses. Of course not. So let's flip the coin and look at the bear case. This paints a very, very different picture, and it's all about the massive headwinds the company is sailing straight into.
And the bear case starts with this one single brutal number: over 20% national office vacancy rate. That is a record high. This is the hurricane that Colliers has to navigate. And even with all that diversification we talked about, a crisis of this scale in your core market, well, that's a huge problem. Now, stick with me here. This next point is a bit technical, but it is absolutely critical for the bear case. On the left, you see the number the company wants you to focus on, their adjusted earnings per share. Looks pretty good, right? $1.80. But on the right, that's the official, by-the-book, legally required accounting profit, what we call GAAP earnings. And that number is just 8 cents. The gap between those two numbers is massive, and it's mostly because of costs tied to all the companies they're buying. Bears look at this and say, hold on, how profitable is this business really? It raises some serious questions.
And that leads us perfectly into the engine of Colliers' growth, which is also its biggest risk. We're talking about the roll-up strategy. It's a classic double-edged sword.
So what in the world is a roll-up? It's actually a pretty simple idea. You find an industry that's got a ton of smaller, private companies, like engineering consulting, for example. And then you, as the big public company, just start buying them up, one by one, and rolling them up into your bigger organization. The goal is to create a giant that's way more efficient. On paper, this is just a genius way to create value for shareholders. Let's say you buy a small private company for 6 times its earnings. Once it's part of your big, publicly traded company that investors are willing to pay, say, 12 times earnings for, well, you've basically just doubled your money through something called multiple arbitrage. This is the playbook Colliers has been running, and they've been really good at it.
But, and you knew there was a but, the reality is so much harder. You've got huge risks. Trying to smash different company cultures together can be a disaster. You could lose the amazing people you just paid a fortune for. And when everyone is trying to buy companies, it's really easy to get into a bidding war and just plain overpay. And maybe the biggest risk of all, this strategy is almost always fueled by debt, which just piles more and more financial risk onto the company.
So you have this compelling bull story and this pretty scary bear story. How does a regular investor actually figure out what's really going on? Okay, let's look at the key numbers you absolutely need to be watching.
Putting Colliers side by side with its competitors is so revealing. First, you can see it's smaller than the behemoths like CBRE and JLL, but look at its valuation. That forward PE ratio is right up there with the big guys. Now look at the debt. Its net debt to EBITDA is higher than both of its bigger rivals. Bulls will tell you that premium valuation and higher debt are totally fine because the growth is so much better. Bears will tell you it's a huge red flag for higher risk.
So think of this as your investor dashboard. Don't just watch the stock price, okay? You gotta look under the hood. You need to track their organic growth. That's growth that doesn't come from buying other companies. You need to watch the profit margins, especially in that engineering segment, to see if the roll-up is actually working. Keep a close eye on that debt ratio, and finally, watch the money flowing into their investment funds, and of course, that gap between the adjusted earnings and the real GAAP earnings. These 5 things will tell you which story, the bull or the bear, is actually coming true.
And at the end of the day, it all boils down to this. This quote from the analysis we looked at just says it perfectly. Has Colliers truly built something durable, something that can withstand any weather, or have they just bolted a bunch of shiny parts together that are all going to get dragged down by the sheer gravity of a terrible real estate market?
And that is the question we want to leave you with. Because for an investor, this is the whole game. Is Colliers a resilient, forward-thinking business with a brilliant management team that's set up for growth? Or is it a company using a high-stakes, high-risk strategy that just can't fight the powerful gravity of this market? Which of those 2 stories wins out is going to decide everything for this stock.